without further ado, it's my pleasure to call on stage. I go left to right as we go. So we'll have Paolo Bortolin for BIL Suisse, also a great supporter of CVA. Thank you, Paolo, for all your contributions in the last years and this time as well. Also co-organizer of the symposium. Second, we have Sandro Knöffel from the Cardano Foundation, located also here in the Crypto Valley. Next up, we have Philip von Moos, likewise from the Crypto Valley, from the Solana Foundation. And last but definitely not least, we have Matthew Matrusak representing Cosmos Labs. Please put your hands together for the four gentlemen.
Thank you very much. So good afternoon, everybody. I understand this is the last panel, so thank you for staying here. It must be very hard after a long, long day like this, but very interesting, I think. I haven't seen some panels, so very, very interesting. Yeah, before to start, and we will try to keep it very, let's say, informal, because here we have three very interesting speakers from three layer one blockchains, and they have a lot of things to say. But first of all, I would like to thank the Crypto Valley Association Board. They have organized this, I have co-organized, but thank you very much. But even more important, the team, for the logistics, Nikki, Saskia, and all the guys and girls from the team organizing this, because I have some picture of yesterday evening. They were here, installing everything. And so thank you very much to the team for organizing and letting us do a very interesting day today. Thank you very much. Maybe a big applause for them too, right? Please. So let's start briefly on our panelists. So Sandro, Matthew, and Philip, please tell us something very short about you and the blockchain you work for.
All right. Thank you so much.
In this direction. Yeah, let's make
Perfect.
it very
Great.
simple.
So thank you so much for having me.
In the importance, but just in.
And yeah, I can also, just as a testament, over the last years, we have seen such a great evolution of the event and the whole industry here in Switzerland, and people from you joining from Europe and overseas. So I'm glad to be here again and see that we mature every year. So that's amazing. So my name is Sandro. I'm leading market structure and strategic partnerships at the Cardano Foundation. My background is in capital markets, where I was 20 years until 2021. And since then, with the Cardano Foundation, looking into infrastructure topics. For us, is really how can blockchain be used for institutional adoption. So this requires a lot of compliance, regulatory topics, and we will go a bit deeper in a little after that. For those who don't know Cardano, we are a so-called third generation blockchain protocol. We are headquartered in Switzerland as an independent non-for-profit organization.
Philip von Moos, CFO, Solana Foundation. Solana blockchain is well known for being very fast, cheap, high throughput, and we think that's a very good basis to build on top the markets or the capital markets for it. And in the end, it's all on the internet, moving value on the internet. So it's bringing internet capital markets on chain.
And I'm Matthew. I also want to say, first and foremost, thank you all, also for your continued attention. We know it's been a long day, so we'll keep this very interesting for you. I am the VP of Operations at Cosmos Labs. Cosmos is, no offense, Sandro and Philip, the world's leading layer one blockchain stack. And I say that in terms of also quantity of blockchains. Cosmos secures over 200 different blockchains in production, and over $70 billion of assets are deployed on Cosmos. It also, there are no digital islands. They're all interoperable, and Cosmos processes millions of blockchain to blockchain and blockchain to off-chain system transactions every month in the tone of billions of dollars of value. And so if you haven't heard of Cosmos, that's a little bit about it quickly. And again, no offense to
well, that's what we're here for, right?
I mean, let's be clear, the discussion is open. It's not a war, you don't have to compete. But I want you to give some insights of why you could be better than the other one, but we will reach this at the end of. But let's talk a little bit. We have here three important layer one blockchain. I mean, when you talk about Bitcoin, Bitcoin is Bitcoin. I always say this sentence is perfect. But then layer ones is really the infrastructure where we can build everything. So these three blockchain have some different characteristics. That's why you are on stage. And I think that the very first question today, considering also the audience, is why layer one blockchain matter for the banks, right? So I will start with a very simple question, and then you start, we go in order, why not? Should banks build on public layer ones or private permission DLTs? So please, Sandro, start from Cardano.
Yeah.
Point of view?
Private blockchains, permission blockchains, they serve quite a good foundation if you want to get familiar with blockchain, if you want to keep control. It's a way how you can internalize certain things. So there has been a good reason why some of the industry started with private permission blockchains, but we have also witnessed that private permissionless blockchains do not really satisfy or solve the problem of assets control, the ownership and the control of digital assets as we have them today. So what public permissionless blockchains as layer ones, such as ours, provide, it's something new, and that's neutrality. So how can you have a neutral ledger where you can put your data in a trusted environment? To achieve this, there are a lot of different aspects we need to consider, but this is like the core idea. If you want to onboard your partners, your clients, you know how it is today. If you onboard them in an isolated environment, you create fragmentation. If you go on an open permissionless chain as a base layer, you can create a neutral layer, people can trust, people can verify. And this is the key element. It needs to be verifiable for everyone. And on this, you can create the control mechanisms. Yeah.
What do you think, Philip? What about you?
Yeah, I think if you, on a first principle basis, if you can use a blockchain, which one are you going to use? The opposite of private means permissionless. That means everybody with an internet access can access it. So why would you not build on a system where you have access to 5 billion potential clients, 5 billion potential clients of your products? The reality is, if you're a bank or somewhere else regulated, you're operating in a framework that doesn't know that you need to have a central point. And then, I think it's more a reality for them, these players, to build on a private chain. But with it, I think comes the costs, where you mentioned a few, right? Like the neutrality. So if corporate A launches a chain with competitor B, is pretty sure that competitor C will likely not join this chain, and then you're already back on two chains. And why does that matter? It's, I think, two main things. One is composability, and the other one is liquidity. Sounds very, very theoretic, but one amazing thing about blockchain is that it's programmable money, that you can program different transactions, sequencing into each other, being dependent on each other, and when they live on different chains, this programmability breaks. And the other one is liquidity. I think we've seen this over the last couple of years, different banks building their own chains, and then figuring out that they have to connect those because the liquidity is fragmented, and that is like anybody that runs a trading system, that is like the one thing you don't want is to have fragmented liquidity. You want to have it in one place, as deep pools as possible, as tight spreads as possible. So
interoperability is very important, but now maybe, Matthew, you have something else to say, since your ecosystem is quite different from the other two blockchains, so
yes,
tell us.
Yes, it could be. And so I think I would start by reframing the question a little bit. I actually don't think it's a question of public or private. I think it's a question of what do you need the distributed ledger technology to do? Fundamentally, what do you need it to do? And I think you need three things. You need control, in some sense. Neutrality is good, but you also don't want to tell your board or your compliance team or your regulator, hey, if somebody else has control of my decisions, right? So you need control. The second thing that you need is you need the ability to determine your own commercials. This is related to control, but you want to be able to set your own fees and your own fee structures. And the third thing that you need, and again, this is why I say it's a false choice. The third thing you need is interoperability and connectivity. And we have built for the past 9 years, we've been in production for 6. We have built these at the core of everything we do, and so that's how we've approached the public versus private problem, by reframing it.
Yeah, you want to add something?
Yeah, I think it's very nice said when we speak about control, and I think that what goes very well along what Philip said, it's the programmability, right? I think this is the key word here. So you have the neutrality. That doesn't mean that you have to give up control. it just makes it verifiable again. And I think that's a key element. And when we speak about interoperability, it's also about not only the interoperability between chains, which I highly appreciate. We have a bridge between amongst each other, but it's also how can we be interoperable with the system as it works today. And then you see Swift, you see others, they are deploying solutions utilizing public permissionless blockchain, and they act more as a coordinator on top of it. And this then control versus neutrality to have a stable network.
Yeah, I think layer is a good concept, because I think how some actors got comfortable with it is that the layer one, the validator, is well, is it 500 or 1,000 or 3,000 or 50,000 depending on blockchain, but that is like they got comfortable that they control it, but like also nobody else controls it. But then for their other operations where they want to be in control of fees, etc., that it's on a token level, the permissions kick in, where you have white listings of users on a token level. But in the end of the day, it's going to be an economic questions, and that's also one which is very prominent on Solana, right? When you have what part of or that is being discussed, what part of the margin should go to a validator, what part should go to an app that runs on a validator, what to the end user, and in the end, it needs to be profitable for all of them, because if there's no apps, then there's nothing to process for the validators. And in the end, there also needs to be a margin or a benefit for the end users, otherwise there's nobody uses it. Okay, so now, let's be honest, layer one exists since years now. So what the real institutional use cases who are live on your blockchain, on your chain, this is very important, because I think, we are still lacking a lot of adoption in the world. I'm the happy issuer of 5 digital bonds, but still we don't have so many. And why we don't adopt? So what are the institutional use cases? We start from you, Matthew, this time. So bring some really concrete cases that work.
Yes.
And the numbers also, if it's possible.
Numbers.
Some numbers, yeah.
Okay, we can do numbers. So I'm going to talk about 3. I'm going to talk about 1 mortgage and credit use case. I'm going to talk about 1 cross-border settlements use case. And the third one that I want to talk about is tokenized securities and assets. And then there's countless others, which unfortunately I'm not at the liberty to talk about, but happy to discuss use cases outside as well. So the first one, and you wanted numbers, Paolo. The first one is that Figure, which is the world's, I completely retract that statement, the United States leading non-bank HELOC lender. And Figure has built and deployed a blockchain on the Cosmos stack. They've compressed the value chain. So they've totally compressed the value chain, and they have originated $17 billion of loans on the platform. They've driven 117 basis points of cost efficiencies, which equates to about $200 million of savings for their business. And they've also driven speed efficiencies of issuing and settling loans 3 to 8 times faster. And so that's one example. The second example I'd want to give is Project Pax, which is a consortium. It's also built with the Cosmos stack. It's a consortium of Japanese banks, including Mizuho, MUFG, and one additional bank. And they were aiming to improve cross-border settlement efficiency, as well as improve efficiencies across the settlement leg. And they've also built with Cosmos. And in addition to that, there are tokenized securities and assets, such as Ondo, which has tokenized $2 billion of assets, which are totally interoperable, as well as one of the US's top 5 banks, which is aiming to tokenize $2 trillion of deposits. And so these are all built with the Cosmos stack, as well as governments across the world and more.
So adoption is there a little bit, but we still have to onboard a lot. So this is the message for all the banks and the traditional financial sector operators. So please adopt this, please.
Yeah,
Philip.
there's the 200 to 300 billion use case stablecoins, right? Not all of it is institutionals, but clearly some or a lot of it is institutionals using it. When early days in crypto, like Bitcoin as a peer-to-peer cash network, it was always for years we were on conferences and saying, well, the cross-border money, like the Western Unions of this world, they charge so much, the fees are so high, crypto can solve this. And now Western Union starts building on crypto, building on blockchains to move their assets cross-border. So they themselves are going to use that technology. I think where institutionals, I think a lot of use cases are now like on the trading side. So, for example, a regulated it's an exchange in the US, they do for ETFs, they buy the underlying Bitcoins when there's, for example, when there's a subscription, but they first have to deliver the Bitcoin and only then they get the dollars from the ETF. So to bridge fund that, they go and borrow in a decentralized, in a DeFi protocol. And the settlement process can be as short as like 90 minutes, so they need that pre-funding for 90 minutes. So you can go on-chain, and they basically borrow this, and this is like high double-digit, low triple-digit amounts, borrow this, use it for the settlement, and then 90 minutes later, they pay it back. And I think a big of the gain is on that efficiency level, where it's like you get a loan on a collateral, and you don't need to do that for years or months. It can literally be seconds that you take that loan.
What about Cardano, Sandro?
Yeah, first of all, I think we have heard about like the use cases which have been established with the stable coins, right, and then the peer-to-peer with Bitcoin transactions. When we look into it, and to your question, why we are here for many years, right? We exist, Cardano exists for 8 years. You never had any downtime, and now you're asking, why don't we see more institutional adoption? One of the things is that for you here in the audience, you are mainly with banks, financial institutions. So we talk about the RWAs, the tokenizations, the listings. That's all nice and good. That's the nice part of the business. But all of you know, if you don't fix the post-trade problem, we don't get anywhere. And what we have seen in the past, we have seen tokenized products, fancy products, which are new and exciting. But one hand, they don't serve a need in the market. They don't solve any problem, but they create additional problem. When you speak about ownership, what comes with fractionalized real estate. We have matured a lot, but in the very beginning, no one looked at this. They only looked into the tokenization part. So what we do is we solve these type of problems on an infrastructure layer. On an example, how can you transfer an asset on chain? We ourselves put our financial statement on our blockchain, which is nice. So now you can go and verify it. But that's nice, but doesn't really solve a problem. So what we did this year with our auditor, Grant Thornton performed their audit, and our financial statement from 2024, they made an on-chain attestation by comparing the transaction on-chain with our ERP system. So now we added an additional layer of an on-chain attestation, and now the missing part here is how do you verify that an entity who did the attestation is eligible to do it? And therefore, we utilized an identity layer we have, an identity platform, which leverages VLEIs. For you, I understand you all know what an LEI is. And by having a VLEI, we now complete the value chain of financial reporting from issuing, putting it on chain, getting verifiable, but then also have the credentials to prove that it's true. So these type of things solve a lot of problems. When you now start to think about what does it mean for NAV calculations, insolvency cases, when you can do this on-chain, verifiable, and on a much higher velocity, you're going to change the game. But to get there, you need to fix these things, and that's what we have been working over the last years. And other things is also, when I mentioned, you need to solve a need or a problem. So who is interested to add a new asset class which already exists? Yeah, you can create operational efficiency, but then you need to have the infrastructure layer to be already there, else it's not transferable. So what we did, we issued an reinsurance fund at the London Stock Exchange, DMI. And the beauty there is that usually a direct investment in a reinsurance vehicle, you need to have very deep pockets. So you need to have $1 million plus ticket size. And now, suddenly, what you can do is you can access such an investment vehicle with the minimum ticket size of 50K for qualified investors. So for your institutional clients, you suddenly open a new market they haven't had access to before. Additionally, it's a market which does not correlate with equities, with anything else. And right now, as we speak, if you would turn up the TV here, I haven't looked at the market today because I simply didn't want to know, but we all know what is happening. And now giving you an access to an instrument which does not correlate, and you haven't had access for, that solves the problem for your client. So we have the buy side and the sell side starting to picking up. And then we also speak about identities on AIs. We all use AIs, but do we know who's accountable when I make a prompt and the AI gives me a solution? This becomes very difficult. So we partnered up with the German company, and they have onboarded over 500 large enterprises in Europe, which deploy AI agents. And in the engine room on Cardano, they have an identity, verifiable credentials, and a payment rail with stablecoin. So they can start to monetize it. For the people who are using it, they don't know that there is a blockchain on the line. And this is the crucial element. How can you embed blockchain in a way that it really solves problem, adds value, and it's potentially not even visible to the broad mass?
So quite interesting use cases. We are not talking about hundreds of thousands in value. We are talking about hundreds of millions, billions in value and transactions. So I think adoption can be there, but we have to convince a little bit more the audience to really adopt for everything. So what is really missing, Matthew, we start with you, to really bring on-chain all the bonds, all the shares, all the funds, all the financial instruments. What is really missing?
So I want to start my answer by saying that I don't want to be presumptuous. So I'll frame it that way. I do think the capability is there. We've seen SDX issue somewhere around the order of $1 billion francs of tokenized assets. The first monetary policy instrument in Switzerland was issued in June 2024. So I think the capability is there. I've heard that you need two prongs. You need the settlement prong and you need the cash prong. And one without the other is not going to enable the world's liquidity and cash to move through the rails that we've spent many, many years building, hundreds of years building. And so with that in mind, I think the thing that is missing is the network effect. That's going to come. I know that the cash problem is being solved by Project Nexus. I know that Pontus. I know that there's Kivalis here in the market. I think these are going to go a long way. And I would say that the network effect that follows on from that is going to be the missing piece. In addition, before we just think that's it, I think also external pressures are continuing to build and are continuing to, we've heard from a lot of our customers that deposits are leaving, their customers are leaving because they want yield on stable coins or elsewhere, or they want to interact with something that blockchain enables. And so that's another consideration as well, external pressures and network effects.
Okay. Philippe, what do you think?
Yeah, I think one very basic thing is still, we talk about tokenization of assets for many years on these panels around the world. I think what changed over the years is that now there's more. It's not there yet, but there's like the financial players like bank, asset managers, they have more infrastructure in place, like custody, staking, just the basics, connecting that to their internal booking systems. All these are big and long projects, and that needs to be in place to come at scale and not in place as a POC. And I think many large firms, small and large firms, have been building this out over the last 2 or 3 years, and not much more infrastructure is there yet. And then it's, I think it's really a network effect, a liquidity thing. So it's, and liquidity begets liquidity. So if there is a way where actors can get faster, cheaper liquidity, then this, then they will change to these rails. And now the tokenized assets on Solana are now around, I think, 2 billion, which is tiny, right? The growth rates are triple-digit triple-digit growth rates. They are insane, but it's still very small. And I think it's like this. Yeah, as network effects go, they have an exponential curve. So it's like slow in the beginning, but then when there is more traction and more liquidity, that attracts more liquidity, and that I think is a function of infrastructure, but then liquidity coming in.
Okay, Sandro.
Yeah, we have heard a lot about this. Was staking as an example has been dropped. I think we have maybe to separate the bridge of DeFi and traditional finance, where we see big moves coming. We see staked ETPs and so on, where in a regulatory environment you're allowed to actually have this bridge. We, as an example, also have an impact staked ETP with the UNHCR, which is super exciting from a CSR perspective. But then the question is, what can you do with these type of assets when we mentioned the digital bonds, right, on SDX. So it's a way how you can increase efficiency, but in my humble opinion, this is the promise when you want to mobilize collateral, and that goes back to liquidity as well a bit, right? It needs to be transferable amongst the industry, and as long as we stay in these isolated silos, it solves a little problem. As soon as we can bridge into other CSDs and have this type of assets working for you, it starts to create value. And I think this is what the SSC non-action letter to DTCC kind of lines out now. You need to have what you said at the beginning, programmability on a permissionless chain. So the SSC non-action letter, amongst others, says that that asset can only be moved between designated wallets. So it needs to have this programmability layer, but it needs to involve the value chain of an asset and not just an isolated system like here in Switzerland. We need to be global. That's what the whole aspect is, right? We are in a global world, so let's interact together.
Yeah. Well, let's put it in this way. Let's meet in 1 year at the next Web3 Banking Symposium. I don't know where we will organize it, and see if in these 12 months we really accelerated everything. Because when I say, you guys exist in some years, but it's still few years. If you think about, in 9-10 years, what we have done, what has been realized, all these use cases that you mentioned is just amazing to me. We are talking about billions, right? So just move more there and see if in the next 12 months is really the period where, we adopt this. Okay. Well, we are leading to the end. Very short answer. I will be a little bit provocative and politically incorrect. The next question is really, if you had to point out one structural weakness in another layer one represented here, what would you say? Because to ask you why a bank should choose your blockchain is too easy, but tell me why we should not use the other one of the other ones. So you want to start?
Maybe rephrasing it a bit, right? So I think
No, the question is this, you cannot rephrase.
All right. The big problem is we should use the opportunity we have with blockchain. But when you go back home into your office tomorrow, will your board ask you, hey, tell me who has the highest TPS? Most likely not. They will ask, which technology is most resilient for us to deploy and provide a trust environment to our shareholders and customers. This is the key question which is going to be asked. It's governance of the underlying protocol. Look into this.
So you don't want to answer, so please feel it. It's kind of too political answer. Anyway, it's a joke.
Yeah, I think if your board might decide something, but then you go out, look for developers that can actually build something on your chain, and then your board might be happy, but your managers and your HR department might be very unhappy. And then you launch a token or something, your first product, and you want to trade it, and then you realize there's no buyers because there's no liquidity and nobody that has a stable coin on that chain that could possibly buy your token against it. So I think you need to be careful what you propose to your board.
Yeah, I guess it's me. I feel it's a bit unfair because no one's pointed out any structural weaknesses yet about Cosmos, which I won't provide them. You're happy to do your own research. However, the one question I would like to ask you both and leave with is, so I'm a bank, I have my blockchain built on, I issued a token on Solana or I issued a token on Cardano. And the validators, a group of people that I have no idea who they are or what they're doing, they decide to stop validating the protocol. What happens to my business operation on chain?
Be very short, please.
Very short, sorry.
We are really run out of time.
What happens to my business operation?
Well, you need to have dozens of, hundreds of validators colluding to make that happen. And I think it's one way is you can always copy the whole chain, right? And then keep a subset of your own validators and then keep that as a copy and keep validating your own chain with your own assets.
Yeah, I'll go quickly. It's important to control
we don't really have
your
time
own infrastructure, and I think that's...
But, thank you. This was a very provocative question. just because I want you guys to go back and study all 3 blockchains, maybe all the other layer ones, because you have to understand the differences and try to find out the best way for you to adopt it. So to me, there are no weaknesses. There are some maybe critical points that you can solve, you can develop there better. But thank you very much for being here today. I hope you get a very nice panel and you learn something more about layer ones.
Thank you so much. It's a great pleasure.